Okay, E12 says, suppose your company sells services of $180 in exchange for $110 cash and $70 on account. And it gives us some requirements. Before we start into this problem, I'm going to say I really like this problem. And the reason why is I think it takes a very simple example and it breaks down the methodology behind why we do what we do when solving for the indirect method under the operating section of the statement of cash flows, right? The indirect method, I told you, the rules that you follow is you start with net income, you add back depreciation expense, and then you adjust for current assets and current liability changes, right? I told you that if the current asset goes up, you do the opposite. You'd subtract that amount from net income, and if it goes down, you would add it. And in current liabilities, they go in the same direction. So if current liability goes up, we add that to net income. If it goes down, we subtract it. This problem is going to show you why. This problem is going to show you why using a simple example with current assets. So the first requirement asks us, journalize the transaction that just took place. So we get accounts receivable of $70. We get cash of $110, and we get revenue of $180, right? This is a simple accounts that we're using. There could be specific descriptors in front of those accounts depending on the company, but this is the simple generalization of this transaction, right? Of this amount, only 110 is in cash, and that's what requirement part 2 asks us. It says, identify the amount that should be recorded as net cash flow from operating activities. Well, in this very simple example, it's clear that the only amount that actually affects cash, if this is the only information we have, it's 110. That's the amount that actually should be reflected in your operating section for the statement of cash flows, right? Part 3 says, identify the amount that will be included in net income. Well, in looking at these accounts, what accounts on here actually affect net income? The only one will be the revenue account, right? So revenue would be included on the income statement. That would be 180. And if we look at the statement of cash flows, which accounts affect the statement of cash flows? Only the actual cash. If this is the only transaction we have, only the cash would be shown in the statement of cash flows. So right here, this makes very clear a difference between accrual basis net income and cash basis cash transactions, right? The part 4 asks us to actually reconcile. It says, show how the indirect method would convert net income to net cash flows from operating activities. So how would we actually convert it? Well, using the indirect method, we start with net income, right? So we'll put 180 here. Let's go over right here. Then we adjust for the changes in current assets. Well, current assets went up. We exclude cash, and I hope that's obvious as to why, because cash is a current asset, yes, but the whole point of the statement of cash flows is to explain the change in cash. So when cash is one of the current assets that we're considering, we don't label that as operating or investing or financing, because the whole purpose of the statement of cash flows is to explain the change in cash. So excluding cash, if we look, the only other current asset that exists here is accounts receivable. And because it was debited, it went up. And as our general rule of thumb says, we subtract when current assets go up, right? We do the opposite. So we'll subtract 70 here. Notice that our ending balance in the cash from the operating section is then the $110. And notice how that agrees back to what we already knew by just looking at the cash. So this example explains why we adjust for current assets and current liabilities the way we do, because our starting point is net income, but our goal is to get to the actual cash. And that's why I like this problem. On part 5, it says, what general rule about converting net income to operating cash flows is revealed by your answer in number 4? Well, it's simply put, it's that changes in current assets go the opposite direction, right? If current asset goes up, we subtract. If current asset goes down, then we add, okay? And what do we add or subtract to? Our starting point being net income. All right, this is E12-2. If you have any questions about this problem, please feel free to let me know.